This is Jason.
Jason, Dale Pinkert, so nice to meet you.
Dale, nice to meet you.
I'm
Thanks for
glad
having
I
me.
found you on Twitter. Your reputation precedes yourself. Sent out a tweet about our interview today, and one of our members said that you're one of the best pattern traders that he's seen. Also, someone talked about your courses, put up an equal sign, and after the equal sign was a dollar sign several times. So, uh, yeah,
That's
so
nice. It's nice to
yeah,
know
it's
it's
nice. I
working.
didn't have to really, give a lot of your bio. I find it interesting that you spent a part of your life in the military as a U.S. Marine. Did that type of training and discipline translate into the battlefield of trading markets and the FX arena?
I think so. People ask me that a lot, and I think one of the more importantly, I think the question that they ask is, did the fact that you were in the Marines and that you did all this stuff and that you were disciplined? So the work I did in the Marines was very specialized, and one of the things that they suggest, and it's one of the great misconceptions about trading. One of the great obstacles that one must overcome when you're trying to teach someone a skill like trading is that they can do it too, because they will look for almost anything to latch on to that says, oh yeah, that's you, but that's not me.
Interesting. So
And one
you're saying a general theme when people come to you is disbelief, negative images because of past experiences, and first they have to get into their head an image that they're capable.
No, I think that's absolutely right. I mean, you know as well as I do, being in this business for as long as you've been in it, that some of the best traders in the world are not exactly the sharpest tools in the shed. It doesn't require a massive amount of intelligence in order to do what we do. What it really requires is a plan, something that produces an expected outcome, positive expectancy, and then the ability to follow that plan every day. And one of the tough things is that people have been met with so much defeat as traders that they have a lot of trouble overcoming this idea that no, you really can do this. This really isn't beyond your capacity in most cases. And what you really need is just a little bit of a blueprint and a little bit of support as you're learning the
Do
skill.
you think that part of it, Jason, is the net is filled with hype and unrealistic expectations so that people come in and they over leverage themselves, and some people think they could trade for a living with 5 to 10,000. I live in San Diego. If I was trading just a $5,000 to $10,000 account, I'd have to live in a pup tent.
Well, everybody would, and that is, I think you're absolutely. One of the big problems is our industry, like most, is full of a whole lot of charlatans. I don't want to talk bad about the industry, but there are really good people who are trying to do the right thing, but too many people get sucked into this idea that, oh yeah, trading is easy, make money. I'm in the currency markets mainly, make money while you sleep. How to turn $5,000, how I turned $5,000 into a $500,000 in just 90 days. These type of claims they're damaging to the psyche because it creates an expectation that can never be met.
Because don't hedge fund managers do cartwheels over 25% returns?
Yeah, that's exactly the point that I make. I'm like, if you can make 3% a
Yes.
month, you are one of the best traders on earth.
Right.
Yeah, and that should be the standard. That should be the mark. Consistent profitability should be the mark. It shouldn't be, well, and the people tend to back their way into it. They say, okay, well, I've got $20,000 and I need to make $5,000 a month to pay my bills. Therefore, I need to adjust my leverage and my trading style to make a 20% return or a 25% return a month. And it's simply an unrealistic goal to have. And that's one of the reasons that people are so defeated.
Yes. Well, can you share your screen with us, and we could take a look at your setups, and perhaps you could talk about your methodology. I noticed that you talk a lot about psychology. I'm a big believer that like real estate is location, location, location. Trading is psychology, psychology, psychology. So is that a big part of your teachings is to, for example, I think I hold up the mirror, and for years, my impulsive trading came because I was afraid of missing trades until I came to the realization that I'm always going to miss trades, but that's okay because there's always another one.
Yeah, and that's one of the things that we talk about in a lot of the. First of all, to your point about psychology, yes, I think that is absolutely the most important thing that most people lack. We talked about it today. I don't run our live trading room anymore. I have another trader, a phenomenal trader by the name of Akil, who runs that room for us. But I was in there because he's on vacation, and I was talking with them specifically about that point. I said, most of the guys who come to us, it's not that they lack knowledge, because our training is expensive enough that people don't just come in, I'm a brand new, straight off the street, I don't really know what I'm doing, and I'll go drop $3,000, $5,000 on a training course. They just don't do that. What they tend to do is they come to us when they've already spent a lot of money on training and education. They've already bought a lot of products and services that didn't live up to their expectations, like we talked about, and now they're really frustrated because they feel like they have all of this information in their heads, but they don't have any idea how to make that work. And they tend to discount that information, like, oh, the other 6 training programs that I went through, those were worthless because those didn't make me any money. When in reality, it had nothing to do with the training program that they went through. It had entirely to do with their psychology and their mentality in the market.
So the Holy Grail is not a system or method. The Holy Grail is controlling your emotions.
No, yeah, you're exactly right. It's not even the most important thing. The system in and of itself, all you're really looking for is something that creates a positive expectancy. And that means over time, it's statistically proven to make more money than it loses. And it doesn't have to be great. It doesn't have to be a trading system that gives you a 2-to-1 risk-reward profile on every trade and produces an 80% win ratio. That would be great if that's what you've got. But good grief, if you've got something that's right 55% of the time and it generates you a 1-to-1 risk-reward ratio on your trade, you're a winner. All you got to do is remain disciplined in that trading strategy, and over time you'll produce a profit.
You're one of the few guests that we've had that I look at your charts and your setup, and that in some way we must be kindred spirits, because I use the RSI a lot for, confirming highs. I, in fact, renamed RSI from Relative Strength Index to Real Simple Implicator because of what confirmed highs and lows imply and how that's actionable. So I'm very interested to see how you use RSI. And what are we looking at? We're looking at the euro right here.
Yeah, we're looking at the Euro USD on a 4-hour chart. I'm going to show you a couple of different things here. Mainly what I look for are 2 different types of trades. They will either be structure-based trades that will be around support and resistance levels, and that's what I'll use our RSI for. My RSI is set to a 7 period with 80 being overbought and 20 being oversold. And so I require a rather extreme reading on that RSI in order to create a viable trading opportunity on a structure base. And what I essentially look for is a market to go overbought or oversold into an area of major structure resistance or support, followed by some sort of confirmation, be it a double top or a double bottom with some potential RSI divergence. And if you trade, using RSI, your listeners are probably somewhat familiar with those basic concepts and terms.
Do you normally wait for more than one divergence, or is one good enough for you to be probing it if it meets your other criteria?
Yeah, one is good enough. Typically, there are a couple of different ways that you can trade it. So let's say that, for example, you've got a major structure level here, and then the market rallies back up into that structure level. We then see the market pull back and double top into that zone, and we confirm some RSI divergence on the bottom of our screen on our RSI. We confirm some divergence there. That creates for me the highest potential reward with the least amount of risk, because I have a clear place on where I can put my stops based on where the resistance levels came in at. So I get my stops over the resistance level, and I create a very nice risk-to-reward ratio typically on a trade like this. Now, there are other ways that we can enter a trade like that. We can wait for the market to break down and actually confirm that it intends to go lower by violating structure, and then wait for a retracement back up into that structure level. We refer to that as a 2618 trade. But there are multiple ways that you can address sort of a structure resistance and support play. You also have another play if the market goes higher. So in essence, if let's say that the market double tops or you end up shorting the market, but it really doesn't give you much of a pullback, maybe just a little bit, the market's reloading here, you got a little false, a little false signal and the market rallies up. Well, now you have a very clear level of resistance that's been violated. And there are a couple of different ways that we can trade this, and it's a basic structure support and resistance type of strategy that we run, either trend or counter trend. Becomes support. I have a saying that I use that people are very familiar with. I say, look left, structure leaves clues. Look left for the structure. Where is the market? One of the first questions we ask before making a trading decision is, where is the market relative to structure? Now, one of the other things that I do and that you heard about in terms of advanced pattern trading is what I'm probably most known for is our work in Fibonacci and pattern trading. So there is, for example, this is a 4-hour chart. I'm actually short the euro right now off of a basic bat, what we call a bat pattern. Okay. Yes. So we have a basic bat pattern that's setting up here, and I use a series of Fibonacci retracements and extension tools to determine where markets are likely to reverse. So in this case, not to get too specific with your listeners here, but in this case, what I was looking to do was sell a bat pattern completion at an 886 Fibonacci retracement, and that's exactly what I did. I sold the market here. The market has rolled over. We're up, what is it, 50, well, about 100 pips or so off of the lows. Or, I'm sorry, off of our highs.
Were you surprised that we didn't pick off the stops over 38.30 before we reversed yesterday?
I was a little bit surprised. I mean, the market ran right up into that resistance level. I was actually, I had a Japanese, a dollar yen trade on as well. I was short the dollar yen, and I was also short euro dollar. So the general concept was there that once this Fed report comes out, something's going to be right and something's going to be wrong. And that's essentially what happened. Was I got stopped out on my dollar yen trade, and this one is now moving in the right direction.
I was there for pound. But yeah, that's interesting.
Okay, yeah, pound, same thing happened. Yeah.
So yeah, because do you believe in stop hunts?
Absolutely.
That made me. It makes me a little skeptical of the break. Although can't argue with the momentum that they didn't take out the last standing bears before this. Yeah, like here. Before this sell-off occurred.
Well, and you think about it. I think about it like this. You've got a light market right now because we're coming into the holiday season. You get a really nice Fed report that kind of gives you the opportunity to move the market around, and you've got groups of traders and you've got institutions that will absolutely push to look for those stops. And that happens all the time. And we talk a lot about, I think in my last, I do a weekly recap or a weekly forecast of the currency markets. And one of the things that I discussed this last time is how to avoid and how to defeat these stop hunters. And it's real simple. You just you select, really decent stops. You don't have stops that are just above key areas of support and resistance. You got to get them far enough out that that the stop hunters have a lot of trouble getting to it.
So is that dependent upon the personality of the pair? How much tolerance above those swing highs and lows you give your stops?
Yeah, for day trading, we've got I typically use a fixed stop because it's easier for people. Another thing we'll use quite frequently and that we teach is average true range. Because I like stuff that's dynamic. As volatility expands and contracts, I know my targets and my stops need to expand and contract. So you can use Fibonacci levels for that because those will expand and contract based on volatility. You can also use average daily range or average true range to determine what percentage of the move do you want that stop to be. So we'll use that as well.
If you can't be wrong for a day, you can't be right for 3.
Yes, that goes to psychology. That's a great.
I mean, there are times where traders, I've done it. I know you've done it, where you've entered a trade and you've had very little drawdown and immediate gratification, but in my trading, that's the exception, not the rule.
No, it is, and especially, one of the things that I do is I trade around key levels of support and resistance. So if you take a look at, say, the Japanese trade the yen trade that I was in, we'll go out to a daily chart here because we'll be able to see it a little bit better. But I got all these Fibonacci just because I was day trading this morning. But let me get this stuff off of here. So I basically, we trade some tick charts, some range charts. Basically, I'm identifying this key level of resistance here, and the market comes up there and holds, it retraces, and then it rallies right back up into that key level of resistance. Well, I ended up selling it right there. Stops above the even handle number of 104s. So we are 104.05s or so for stops. And I had to sit on this trade for 1, 2, 3, 4, 5, 6 days as it went from, down 50 to up 50 pips basically. And then, boom, the market rallied on the news and stopped me out. I was doing the same thing in the euro.
What do you think?
Well, I read divergence just a little bit differently than most people do. So even though I'm still getting the divergence here, I want to see the divergence come in along structure.
Okay.
So I don't want to see the market violate structure because I know from experience that markets can continue to diverge while they rally for a very long time.
I mean, exactly. You don't know how many times I've been stubborn about divergences. My account does. But, it's like a rubber band. I mean, the S&Ps have been diverging for 6 months on the daily.
Yes. And so what I want to see is that divergence occur actually at the potential reversal zone, at the resistance levels or the support levels. Once we get above that, now basically the way I look at this market is I've got a buying opportunity if we can get the market to come back down into 103.22s. 103.20s, that area. Now the market's reloaded a little bit. I got some room to run with my RSI, and I got a buying opportunity there. And again, that's just the way I read the market. You could definitely use another form of divergence to try and sell that market. But to me, this market has proven that it wants to go higher, and so I don't want to buck that.
Okay, that's a pearl. So it's not just a divergence. The price is still your final arbiter.
Absolutely, yeah. Price action. What I tell traders is a chart is the visual representation of all market participants' actions. And what that means is we're not looking at CNBC and listening to some hedge fund manager talk about what he's probably going to do or talking about how he's got all of his multiple positions hedged and rehedged. What we're looking at is every decision that the market makes. So it doesn't matter what the talking heads think are going to happen, what they say are going to happen, what the news might or might not be. That makes no difference at all to us. All we want to do is look at what are they doing. What action are they taking? Where are they putting their money on the line? And you can't hide that. You cannot disguise whether there is intense buying or selling in a particular currency pair or a potential futures pair or a stock. It doesn't matter.
Because you'll see
can't do that.
Price action reject, bounce off of support and reject resistance.
That's right, and it's not 100% accurate. This is one of the other things that people want is they want that system that produces 90% winners. A lot of times the market will fake you out, and it will pretend like it's going to find resistance like it did here, and then a news event will stop you out of your position, and that's why sometimes.
To me, it's most of the time. I really believe from having seen the markets develop from open outcry to black boxes, that markets will shake out as many weak hands as possible before the move they're looking for manifests, then most likely without them.
That is a No. I think that's probably a fair assertion. In the old open outcries, one of the funny things is you're looking at the equities market right now, and they just keep going higher and higher and higher, and you're like, man, they were overbought, and you're just like, when are these guys going to sell? Well, the old open outcry, the old joke was that y'all sat around until the best trader started selling. They're like, everybody's long, but you wait for one guy to start selling, and everybody else starts selling, and it was really a different environment because you could look across the pit at a guy that you knew, and you could look him in the eyes, and you could tell when he needed to sell. You could tell when he was in when he was in the position. You could tell, you knew all of those guys and how they reacted and all those types of things. And that pit really drove the market. Not the case anymore. Now we're looking at it strictly. All I have is a chart. That's it. That's all I have to look at. And so I have to base all of my decisions off of what I'm seeing everybody else do on the chart. And, I can't move the market. Even today, I don't have the funds to move the market. But I can participate in those market decisions and in those market reactions. And that's what I attempt to do.
That's a great metaphor. Because, I was a member of the CME. And I do know that many guys who are very successful on the floor with paper flow could not make the transition to being off the floor traders. Yeah.
Mm-hmm. It's a very big change in the way the market moves and the way it reacts. It does react differently now than it did when pit trading was was still the backbone. And that's really before me. I'm kind of basing that off of what I understand, knowing a lot of professional traders.
It off of. You watched Trading Places with Eddie Murphy and
that's exactly right. Yeah, the orange juice. That's right.
So we've had this year the star was definitely the yen weakness and the yen crosses, and we're wrapping up 2013. Do you use a telescope, Jason, and go out and look at things like weeklies and monthlies to give you kind of a look ahead as to what expectations might be in the markets?
I have tried to do that in my own trading, and I've met with limited success doing that. What I try and do is I try and look at what am I trading today? Because if I can't anticipate if the weekly chart says that it's going to go higher, or the monthly chart says, hey, next year the euro should be higher. I listen to too many pundits and too many talking heads talk about that stuff who, I don't know how they're coming at those assertions, and sometimes they're right and sometimes they're wrong. All I can do is look at my methodology. I use, my trading time frames and say, all right, what am I seeing? What's happening right now. And so I really try and stay away of trying to predict what's going to happen next month or next year, because I have no skill or talent at doing that.
Great answer. Okay. So we're looking at perhaps a potential pullback and higher levels in the yen. Do you follow any of the other asset classes outside of FX or any?
Sure.
What do you follow the S&Ps? Do you have any view on? We're looking.
Yeah, I'm actually really I'm glad you brought that up. Here's the SPX. This is the way I would trade it. I wouldn't trade the actual futures contract. I would just come in and look at an options play or just a straight. I'm sorry, I would trade the SPX. I would trade. I'd look for an options play here on the SPY or something like that. But what I'm noticing here is. The markets rallied up nicely, but they met this resistance level again. They failed to make new highs. I have said for a number of months now that we will continue to see increases in the equity markets until they start pulling back on the taper, on the 85 billion. Once they start pulling back on that, it's time to look for shorting positions. That's a fundamental perspective that I have about it, because if I just collapse this chart up, it's pretty incredible what you see from 2013. So if I go back, just look at it. There's no significant retracement at all from 2000, right here. This is basically 2013. Just almost a straight left to right movement, and that is a bubble that's created largely from that bond buying that's been making its way to Wall Street, and the fact that there's no interest. You can't make yield anywhere else. If you can't get yield in bonds and you can't get it in safer asset classes, and you have to produce a return, well, you've got to put that money somewhere, and it's going into risky equity assets. That will change as soon as something like we start to see interest rates rise. So right now, what I am doing is I'm long TBT, which is the ultra short treasuries, which means I anticipate equity markets to go high. I anticipate interest rates to go higher. And at the same time, I'm watching the equities market for selling opportunities, and we may be sitting on one now. Like I said, if you look at the Dow Jones, although we closed at new highs, the highest closes we've ever had, we still didn't violate those resistance levels at 16,172s. So I'm watching that level very closely. And if we go over to the Russell and we take a look at the Russell's not even approaching. It's not even back up there yet.
I know. So that was my favorite put play. It didn't work out for me.
I sold puts back here. I'm sorry. I sold calls back here. And I may do that again. I like to sell premium.
Yeah.
I don't particularly like. But
because
so anyway,
options are like relationships, right? 90% of them expire worthless.
That's exactly right. Yep, I like collecting premium, and I like the fact that those odds are in my favor. And people say, well, your risk is unlimited, and it's not unlimited. You know where you're getting out of the position. You're not going to, it's called having a stop. It's the same as saying, well, in the Euro USD, if I buy euros, my risk is unlimited. It's not unlimited unless I just don't put a stop in. So I know where I'm getting out of the position. But in this particular case, I think this is a pretty good area to sell some calls or buy some puts, if the market can show that it actually intends to hold here.
Okay, great. That's an interesting perspective. Yeah. So how about the hated gold market? Do you see anything setting up? We're approaching the lows made last year of 1170. I've been talking about them taking out those lows for a while. You see anything setting up in gold?
Yeah, I've been waiting to buy gold. I have been a huge bear of gold since about $1,700 an ounce. And I think that $1,000 an ounce is going to be a pretty good place to start making a stand if that's what you want to do. Now, I'm talking a longer-term perspective. If you want to break it down on a lower time frame, then, hey, if you're looking for a buying opportunity on a day trade, that looks like a pretty good level to me. Look left, structure leaves clues. You got structure there at 1,200. The market's sitting on that level right now. I just think we're going to go down to about $1,000 an ounce because as I collapse my chart up, I can see that at $1,000 an ounce, that was the last real violation. You got one test, two tests, three, four tests there at 1,000. Nice even round number at 1,000. And if we can get down there, that's going to be a pretty nice area for support, I think. Right below that is 700. Yeah. $700 an ounce. So that'll be another level that I'll be eyeing. If I draw in, let me find 700 here. Right about there. At 700, you see, again, that was the low point. So you had, and again, if you look at this from a perspective of gold, gold ran up and we had this nice little huge move up. We hit the resistance at 1,000. We come back to 700, and then we take off. And we run all the way up to $1,900 an ounce. Well, those two levels, the support level and the resistance level of that retracement, are probably going to be your key levels to watch for.
That's a great look.
So.
And I
anyway,
forgot,
that's
in your TBT position, so you're looking for rates to continue to move up and the bonds to continue to be under pressure.
That's correct. Yeah, I would expect, because what's happening is the federal what the Fed decided to do was they're going to cut $10 billion out, so a little more than 10% of what they've got. $5 billion of that will be mortgage securities, and the other $5 billion will be treasuries that they'll stop buying. So as soon as that happens, interest rates will start to tick up. You'll start to see some pressure in that market for that to go higher. And also, it's simply, I mean, we're looking at interest rates that are ridiculously low, extremely lower than anyone has seen in our lifetime, and will probably ever see again.
Like
so, do I want to be buying bonds? Yeah. Do I want to own bonds at a 0.25% interest or at 1%, or do I want to short the bond market, even if it's on a longer-term investment play, and wait for those markets to shoot up?
Do you think if we finally got that 10% hit in the S&Ps that there might be some type of bear market rally in bonds to send TBT down one more time?
It could happen.
Okay. Yeah.
You know, anything's possible. I absolutely think that that's definitely you know, a way that it could go. I think more likely is the fall in equity prices will be perpetrated by, or will be caused by, a rally in bond prices, because as soon as a lot of these players can get money out of the stock market and into something a little more stable, they're going to do it.
Okay. Yeah, interesting look on that. Any other markets?
But
You want to
anyway.
show your website if people want to learn from you, Jason, and
yeah, if you guys want.
how they go about it,
I own a
how they
company.
find you. I put up your, and I wanted to ask you, what does Harbor Site Capital do? Is that a registered investment advisor, hedge fund?
No, it's not. That is a separate company that's my company, TradeEmpowered.com. Harborside Capital is a separate company that we own, that is going to be it's going to be a facilitator of what we want to do. It's been our dream for a long time to be able to take traders off of the street, teach them our methodologies, help them get started, and then help them get funded. And so while we were not going to be the direct funding component, Harborside Capital will be the go-between that sets up the structure that allows these traders to come in, build real-time track records that investors can then come in and invest in.
Like a prop trading firm?
Yes, essentially but because we won't be handling any of the money, that we won't need the registration. Okay. There's several other business models out here. You've seen like a Pari fund, does things like this, and where they actually, they fund traders themselves. But we can fund traders ourselves out of our own pocket, or we can simply make the trading records, the track records, available for any other investors. So let's say that you are you've got a 401k or you've got investable assets, and you would like something non-correlated, and you would like to put some money into the currency markets, but you're looking for a little bit of alpha, and you're willing to accept a little bit more risk. Well, you can come to us and pick the trader. And pick the style and look at his returns over the last, we require a minimum of 90 days, but then to get on the program. But then after that, you've got, you can have the investor himself will decide what kind of track record he wants to see. And we make that kind of available. So it's a way for a trader to, to actually, who doesn't have a lot of funds, to come in, potentially get allocated.
Yeah, I'm sure there'd be a lot of interest in our community for that.
Yeah. And they could, they can take up to $400,000 without being registered. Once we get beyond those levels, then our business will have to morph a little bit. But right now, we just want to make it available. We know people in the industry who have lots of money who would be willing to allocate based on a 90 to 180 day track record if you can meet certain standards. And so all we want to do is we've got guys who take our courses anyway. We want to offer this as a potential bonus on the back end. What we don't want to do is we don't want to center our education business around getting funded. We want that to be, like icing on the cake.
Great model.
So anyway, one of the other things you can do is if you're not really into giving email addresses and stuff like that, I have a YouTube page. Just Google YouTube Jason Stapleton. Let me see if I can find it here.
Are you based in Chicago, Jason?
No, I'm based in Kansas City.
Born and raised there in the.
Yeah, I was. I was raised there. I was born in Southwest Kansas.
You come from an agricultural background.
Yeah, my whole family was farmers.
So, now I understand how you ended up in trading. So you were following wheat prices and so forth when you were in high school.
Yeah, that's right. Actually, my grandfather is this is my YouTube page, Forex Traders Live. You just Google that or Google my name, Jason Stapleton, in YouTube, and you ought to be able to get to my page. You can subscribe there, and that way it doesn't, you don't have to give your email address out or anything if you don't want to.
Thank you for showing us.
Yeah, you bet. And then my grandfather started trading commodities in the 70s. He was a rather successful farmer and started trading commodities around that and became a very, very successful commodities trader. And that was actually my first introduction into the trading world. Was he had one of those I don't remember that when they first started electronic trading, you know, they had those old, like boxes that came in on, you put a satellite on
Oh,
top of your house and
he
you had
had
this box.
DTN.
Yeah,
Yeah, those
DTN. There you go.
satellite
That's what it
dishes
was.
were huge. Remember that?
Yeah, yeah, and he had one in the backyard. I remember it because it was huge out there, and he had that thing out there, and that that was what he used, and he spent about half of his day on the farm, and the other half of the day, by the time I was old enough to remember, and about half of his day in that office looking at
My
commodity
God,
prices.
that was
And
really a blessing that, instead of you having to go out there and find your way, to have someone in the family mentor you and expose you to this.
yeah, and his was I think I get more mentoring now than I did. But it's kind of funny because I used to just beg for advice from him, which he did not enjoy giving out because I think he didn't want me going and losing money on his on his experience.
Exactly.
But now when we get together, it's kind of funny because he knows what I do now, and now he's asking
Yeah.
me. He asks me questions. He asks what my opinion is, which I find extremely
Yeah.
humbling because I have a lot of respect for him and what he's been able to
Wow.
do.
I'm so glad to meet you, Jason. I look forward to more conversations with you next year. I want to wish you and your family a Merry Christmas and a healthy, happy, prosperous 2014. And want to thank you for edifying our community today. And I'm just so grateful for the community that we have and all the people that I've met like you over the past 6-7 months that have edified LAR, and really appreciate you taking the time today to spend it with us, because money comes and goes, time is gone forever. It's our most precious currency. Thank you for spending some of that with us today.
Well, thanks for having me, Dale. I really appreciate it, and it's been a really enjoyable conversation. And it sounds like whatever you guys are doing over there is working. So it sounds like we have a lot of the same principles and concepts and ideas. So it just shows that we're on the right track.
We reap what we sow, don't we, buddy?
That's exactly right. Yeah, it's about relationships. So I appreciate you inviting me on, and I'm glad I've had the opportunity to do it. And I hope that somebody grabbed a nugget out of what we talked about.
Quite a few pearls today, Jason. Thank you very much, and let's talk again. Let's do it again, okay, buddy? All right.
Anytime.
Thank you, Jason. Good hunting.
Thank you. Bye.